Look, I don't know about mission creep and all the rest of it. I think Fed independence is super important. The market's, a little unnerved by what's going on, obviously with the firing of Governor Potential. Well, she's still there for now as a voting member, but Governor Cook. But, more importantly, if Trump gets a majority of the Board of Governors, I think people will watch to see what does that mean for the reappointment of the regional bank governors 2026. Of course, they all come up for reappointment. So we've got to keep an eye on this. But look, at the moment, I think markets aren't too fussed. Remember, the ultimate guardrail is the long end of the bond market, as we've seen before. And right now, I think bond market is pretty tame. Equity markets have been pretty tame. Remember, we've seen challenges to Fed in the past. This is not new. LBJ was no picnic. Neither was Nixon at the time. So we have seen challenges before.
I'm just trying to understand. I mean, the backdrop of the US economy right now is that US growth is slowing, that the labour market is starting to weaken, and inflation is not back to the Fed's target. And yet the equity markets keep rallying to fresh record highs. We're above 6,500 on the S&P 500. What gives?
So I don't think US growth is slowing. I think the labor market is showing signs of weakness, maybe temporary. Remember, the weakness is coming in manufacturing, wholesale trade that could be linked to uncertainty of the tariffs, construction that could be linked to high interest rates, right? And also government workers. That was Doge. So it's not clear to me that that's not sort of one-time issues. But let's take a look at the economy. I mean, 70% is consumption. Household wealth, which the Fed will publish their report sometime in the next 2 weeks. I don't mean to say anything, but mid to upper end consumers dominate consumption. And since the first quarter they published, I think the market's up 15.5%. So I think people are going to feel good about that cushion. But we've had the view and continue to believe, not tomorrow, not next week, but as we look into 2026, that investment spending will surprise on the upside. In other words, companies have incentives to invest. We already seen a bit of that in the second quarter data. And by the way, the Atlanta GDP for the third quarter is tracking to 3% at the moment. That doesn't sound like a slowdown to me.
Yeah, so it's the robust nature of the US economy that is lifting all of this. What of sanctions, though? Again, something immensely difficult to understand, the timing and the scale of the impact. What's your view there?
You mean the tariffs?
The tariffs, yeah.
So, I think at the end of the day, the tariff level will settle around 17, 18, 20%. We're about 17% at the moment. So far off the 40%, which included the embargo trade war with China. So much less than feared. We'll have to see how the legal challenges shake out. That will go to the Supreme Court. We probably won't have a decision on that until next year. But our view has been, look, even if he gets pushback on IEP, there's like 4 or 5 other statutory regulations that he can liberally employ to keep tariffs in place. And remember, tariffs probably are a transfer of wealth in a way from other parts of the world back to the United States, because remember, they're also bringing income in at the moment. In May, June, and July, income from tariffs was running about $25–30 billion. So there's some good things about tariffs as well. So we'll have to see. And we'll have to see whether the tariffs actually have a persistent impact on inflation. So that remains a challenge as well.
To Europe and the political uncertainty in France, to what extent does the French story, the potential and likely government collapse later today, a headwind for the broader European equity picture?
I think it is a challenge. We'll have to see how that $1 trillion of German, looser, debt break and spending kick in. But what's clear is if we look at Japan, UK, frankly, and France, these countries have very high levels of debt to GDP. And there isn't a clear path other than austerity that they're pursuing that are going to deal with that. And I contrast that to the United States that's looking to grow out of its debt and deficit. Whether Trump and Bessent will be successful, I think, remains to be seen. They're heading to the 1990s playbook, which is productivity, exceptional growth, actually brought debt and deficit levels lower in the late 1990s. That's more of a challenge for those 3 countries, Japan, UK, and France, because they don't have a technological innovation per se, aging demographic, weak political systems, excessive regulation, and certainly in the case of Europe. So I think that is the challenge, and we may see higher bond yields as a result.